What up, what up, what up, what up? What's
Good
going
day,
on?
good day, good day.
It's Brian Erhahon and
Mercedes Erhahon, your real estate specialist.
yes, and we are the RESWealthy team bringing you everything buying, selling, finance, and just overall wealth building strategies to help you win in this game, this market, any market. And
Any
so
market.
at the end of the day, we're here for you. So thank you
Yes.
for joining us today. And if you're joining us for the first time, this is your go-to YouTube content that's going to help educate you on all the moves necessary in real estate. And then if you're coming back again, thank you for joining
Thank
us again. Thank you
you.
for coming back. And we're going to make sure that it is valuable for you. So, quick energy check, Mercedes. We're sitting here uh, first week of December,
Yes.
and
Yes.
we are moving through the year.
Moving and shaking.
So in this moment of energy check, I mean, what's as an agent, as a professional, what's going on in your world? What are you doing? What are you thinking about? How are you winding down? Are you gearing up? What's going on in this end of Q4 moment?
I think it was really nice to take a beat and really spend that quality family time. Brian and I were able to host both sides of our family for Thanksgiving for the first time, so that was amazing and a blessing. And I think a good reset for sure of energy. You hear the stories of, real estate agents. Basically, we're never off. We work 24/7. And honestly, if you don't set boundaries, it can get like that. And so just being able to have that quality time with family really, I think it was a really good energy check for me. And, I'm excited for Christmas, and I'm excited for the people who are still in the industry right now wanting to transact, buy, sell, or invest. And normally during the holiday time, the market tends to slow. So those who are in it right now, they're motivated.
Yeah.
And I think that's important.
Yeah, absolutely. And so we don't always check out or go off the grid or whatnot during these years. I mean, sometimes we typically have a really strong fourth quarter because, for those folks who weren't able to sell during the year, there's still a shot. And then for those folks who are looking to purchase, there's definitely a shot right now. And so if you're in the market during the winter season, it is a good time to deal with motivated folks. So
Mhm.
if you're a homeowner and you're looking to get something sold, get a property sold, it's not a bad time. Being that as long as you're motivated, there's still buyers out there. There's still people who need to purchase, and you can still find a great buyer. So for buyers, the homeowners on the market right now got to be pretty motivated for them to be making preparations or whatnot during the holidays. So just think about that. Uh, Anything you'd add to that?
Let's dive in. I feel like this transitions well into a lot of first time buyers right now are coming into the market around this
Yeah.
holiday time, Brian. And why do you think that is?
Yeah, I mean, so that's a great segue right into our market pulse, right? And so, market pulse, is just one of the, what are some of those trending topics, trending moments in the industry that we see that we can keep you up to date on. And so, one of the things that we're seeing is that that kind of squeeze that the home buyers had felt from 2023 to 2024. It was basically the increase in the cost of living. Actually, it was more of 2022 to up until call it this year, where there's just a lot of folks who just felt that squeeze, that tightening of affordability. And so when rates went up, and frankly, prices haven't moved very much in Southern California. So because of that, you have the kind of the double whammy there: high rates and perpetual higher prices in home sales. That's where you get that double edged experience or feel right now. It's like, man, how do I afford a higher sticker price for a house and higher interest rate? And so there are definitely I think because of the time over the last, say, call it 3 years, folks are now starting to settle into the fact that not much is changing, not much has changed, and people are expecting a big crash or expecting prices to fall.
And they're realizing
It
it
hasn't,
hasn't, and you
and
don't foresee
not
that.
yet. And let's just say prices did fall, prices did come down. there's still a good amount of people who have been pent up over the last 3 years. You got to think about, millennials, Gen Z who are starting to jump into the game now, baby boomers who are still in the mix. And then you also have Wall Street and venture capital. So, all those folks are buyers. You got your, small time investors. And so all those folks are buyers. And, they've been on the sidelines waiting for a good buy, a good opportunity. And unfortunately, because and one of the things that we're seeing now too is that we're seeing higher days on market. So homes are sitting a bit longer now. So one thing that's getting home buyers off the fence right now, Gen Z and millennials, is that there's a lot more choice in the market. Over the last few years, we've been battling with that inventory bug and not having enough options, which still continue to, kind of keep prices stable and up. But now we're seeing prices start to be a bit more flexible and negotiable because we have a bit more inventory on the market than what we had, last year and the year before that. And so we're in, so overall, folks are getting tired of waiting because the rents are continuing to go up, and you've got more options now. And then you also have rates starting to come down and move in the right direction. So people are starting to say, okay, well, we do see light at the end of the tunnel. And there's a bunch of different options out there. We'll also get into how financially our first-time home buyers are financially making it work in a moment with different incentives and programs. However, at the end of the day, first things first is you've got to want to go buy the home. A lot of people don't realize that, it's very difficult for you to say, going from hot to cold or cold to hot, meaning I'm out of the market, I'm out of the market, I'm out of the market. And then, they see a great home, like, okay, let me jump in. All right, by the way, let me go get my tax returns, let me get my documents, let me make sure and then before you know it, that home is gone. And so the folks who are winning in this market are the folks who've been in the market, been watching it, been studying it, been talking to a mortgage professional and agent. So when that home jumps on the market, it's not a surprise. And they're able to take advantage of it because they've been in the market. You can't take advantage of the market if you're not in the market. You can't go out of the market and then in the market and take advantage of a great deal if you're not prepared. And so it's that idea of, was it opportunity is luck, luck meets preparedness. So, a little bit of luck for that, one home that's been on the market for a little while, but then you've been prepared to take advantage of that great opportunity that may pop up versus someone who's waiting. Mercedes, what would you add on to that?
Well, that was a lot to take in and process. I want to make sure that
Good stuff. Good stuff.
We take a beat. I think, to touch on what you mentioned about, why we're seeing more buyers too. I think the true realization that people back in 2021, 22 who said, I'll wait, I'll take a beat, I'll wait, the market's going to crash. I keep hearing that. And those people, some of them, unfortunately, are priced out of the market.
Yeah.
They were in a position to be able to buy. I have a laundry list of people who, were in that position in 2021, 22 to buy and listen to the hysteria in, the market and said, I'm going to wait. And that same house, say it was 300,000 at that time, is going for 5. So someone who was pre-approved for 300 now in 2025, that same house is going for 5. It kind of starts to put things out of reach. And so I think that especially with the Gen Z and the millennials are coming to that realization of, I don't want to be priced out. If you have a dream of home ownership and that is a goal for you, whether it's, a primary residence or an investment, act when you're ready, willing, and able to, period.
100%, 100%. And obviously we're always about the data here. And so, one of the things that we're seeing that is actually really good, I just hinted this before, is that, rates are starting to trend down a bit. And so when you see how rates are moving, in a positive direction, right? Mortgage rates are trending down. This 30-year mortgage fix mortgage rate. I know it's a little bit hard to see, but this goes from January of 2025 to now. And you see just rates at the beginning of the year. A lot of people forget rates were at, average sevens, right? Low sevens. Now, if this was zoomed out to last year, it could have been 7.5, almost 8 last year. So you see here, we're already starting to head down to low sixes. So very, very good news. And here's how, we're seeing this actually translate to your monthly payment. Look at that. And so just by the way rates have trended down, folks are just saving, almost on average, uh, $300 to $400 every single month just by doing nothing. Rates just came down, and so now here's one of the things that we're projecting is that for those home buyers out there and anyone looking to make a trade up move, we always like to help people see the benefit behind making the move before, the calm before the storm. And that calm before the storm is, as rates continue to move, and let's just say, and there's been studies that show that once rates hit that 5 to 5.5% range, then the activity level should feel like COVID again. Now, we don't know if that's going to be the case, but you start to think about the multiple offers, the more demand, the higher activity. So as a buyer, wouldn't you want to already own a home versus jumping back in the fray? Now, if you don't have a choice, you don't have a choice. That's fine. Now, if you do have a choice and you can afford what you're looking for now, jump in the game, own, so that way when rates come down to 5.5, what's going to happen? Mercedes, what's going to happen when rates come down to 5.5? What should we expect to happen when rates drop another point?
Well, have you heard the saying that was going around? Marry the house, date the rate. And I think that goes into what Brian's saying right now is when the rates drop, if you're purchasing currently now, you have the opportunity to refinance your home and get into a lower rate. And that'll set your payment at a lower feasible as well. And with that, you're avoiding what can come when the rates drop to 5%. If you don't want to be in bidding wars, if you're like, I don't want to play that game, I just want to lock something in, the time is now. If you're comfortable with your payment at the current rate it is now, you should definitely move into that home ownership and have the opportunity when rates fall to refinance and save yourself a lot of money and heartaches. Sometimes people go, well, why would I wait, or why would I do that now when I can get a lower rate? However, your price goes up. And so you're battling those two. Do you want to pay more to have a lower rate? Or do you want to get into a price that feels comfortable now and then be able to refinance for a lower rate and lower your payment? So those are some things to think about.
Very, very good. Very smart. So when we look at, just how, again, more options are popping up right now for buyers. So you see here, we're about 1.1 million homes active, just kind of revolving. And this is October each year. And so this data comes out, so we should be expecting November data here in the next week or two. However, looking at October over October, you see where the numbers have been as far as active inventory. And so we're up over the last few years, fortunately. Meaning, again, those of you out there looking for property, you got more options. And when we look at this, what does this mean for buyer demand? So purchase applications were down over the week, but remain 20% higher than a year ago. And that goes right back to rates have been coming down, trending down. That's obviously a benefit. And then going into next year, we're expecting, right this year, we are projecting a 4.8 million annual home sales across the country. Now, that's been, kind of dragging along the bottom of where we are used to being. We're used to being in that 5 million, 5.5 million range. Next year, we're looking at 5.2. So, for those who are looking at, your options and, when do I enter in the market, I kind of go back to a time where if you look at 2009, 10, 11, I might even have this chart, but the idea is that if you were to ask anybody, wouldn't if you were to buy a home in 2009, 10, 11, would you buy more real estate in 2009, 10, 11? And the answer is Mercedes?
Of course.
Absolutely. Why? Because
Mhm.
where you knew you already have foresight, knowing that, man, there were so many great homes for sale, and I could have bought more, because what we know today is that the value has gone up over those years. Now, when we look at where we are today, and there's a really good chart I'm working to find here, and we start to look at, okay, where have the people been, right? First time home buyers, percentage of first time home buyers over the years. I really love this chart because this is a really good reminder that when everyone else is a little fearful, that's when is a great time to jump into the market. Because when you look at these stats here, and I'm going to go ahead and share this screen with you. If you look at these stats, and and uh, and you really realize the percentage of people who have an opportunity to purchase but haven't jumped on it yet, you kind of wondering why. So when you let's look at this. So in 2009, 2008, the 41% of all buyers were first time home buyers. So in 2008, 41% of all home buyers were first time home buyers. 2009, 47%. And in 2010, 50% of all buyers were first time home buyers. Whereas, let's go back. In 2006, why was it only 36%? Well, what was going on in 2026 or 2006? Well, the market was so crazy. Everyone was participating in to where there was no room for first time home buyers. First time home buyers couldn't compete with the investors, the trade up buyers, the people who have 20%, 10%, 15% down. And so when you look at that, what was going on in 2009, 10? Everybody was telling you don't buy a home.
Yeah. The market just crashed.
Oh, it's
The
a bad time.
worst
It's the
time to
worst time to
buy.
buy. But then when you look at a chart like this, it's like, well, dang, this is when the home buyers jumped in. And by the way, we're able to get in 2010. One of my first clients, I was able to get her into a home for less than 3K out of pocket, down payment assistance, plus closing costs, and a lower sale price compared to the asking price. That's a triple whammy, right? So lower sale price, you got closing costs, and you get down payment assistance. That's how you get into a home for a little as 3K out of pocket. And so the numbers might be a little bit larger. However, the idea remains the same. Is when there's fear in the market, look, and you have the ability to look long term, and you're going to say, all right, well, I'm going to be in the home 5 years, I'm going to be in the home 8 years, 10 years. Then you look at this and say, all right, well, what's the best deal that I can get,
Hmm.
particularly right now in this wintertime?
In any market, though,
In
I
any
think
time.
I think first time buyers in general, depending on what you're looking for, should be looking for what can I obtain and get the best ROI, right, on my investment. And for our first time home buyers, if they're not doing new construction, because that's a whole nother conversation, if they're choosing to do resale, we're educating them on, hey, if you want to negotiate more on pricing and being able to obtain closing costs credits from the seller, let's look at properties that have been sitting on the market a little bit longer, 30 to 40 days. I mean, the way that it's been right now, up to 60 days on the market, those sellers are going to be more motivated to do price reductions, to negotiate. And if you're a first time buyer where you're like, I have enough for my down payment, however, I don't have enough for closing costs, those are those properties that you'll have more opportunity to ask the seller, hey, love your house, want to move forward. Are you able to help me help you sell by allowing me to have some closing cost credit? So that goes into, our negotiation tactics as well for our first time buyers when, cash flow is limited. However, you still have that dream of home ownership and building that generational wealth.
Well, you look at that next year, right after 2008, 9, and then 10, then you get into 2011, and then you see that it drops. It goes from 50% to 37%. What happened? Okay, well, Wall Street jumped in. What happened? You had State Street, you had Viewpoint, you had all these different venture capital Waypoint Homes come in and start buying private. By the way, which a lot of haven't sold yet. They're all just holding on to the market because they know one of the best investments is residential housing. Hold, buy, hold, rent, and keep, right, for long term. and that's that recipe that they're playing right now. And so you look at that just in 1 year, that going from 50% to 37%. And it hasn't been as high since. Why? Because now we need to update this chart. Obviously, this goes to 2022. However, I would imagine in these last few years, first time home buyers are up, are up. All right. So how in the world do you make this happen? We've kind of you hit that point pretty well, which is what's going on in the market right now. Why are first time home buyers returning? Next trading topic is what in the world do they do to get financing? And so there's a lot of really good options for financing for first time home buyers. And being on the mortgage side of things, we see a lot of different opportunities for first time home buyers. Now, one of the big things that we need to be aware of, though, is that not everybody is going to be able to do down payment assistance. The reason why I say that is because depending on your situation, it may not make sense for you to use down payment assistance because if your numbers are already tight as it stands, then down payment assistance, that money isn't always free, and because that money isn't always free, that can actually end up uh, lowering how much you can qualify for. It might be the difference between you being able to get a 4 bedroom and a 3 bedroom. And so if you have your own money or gifted funds, a lot of people don't know you can use gifted funds. Uh, then you know, eh, then yes, you don't have an option to use down payment assistance. But if you have your own money or you have the ability to use gift funds, then that is a good option for you because now that money isn't quite as expensive and it's not going to be counterintuitive, meaning that your qualification is dropped because the interest rate on uh, your loan is a little bit higher now. So we do have so there are grants. There are also what we call silent seconds, and then there's also just the traditional seconds as well. So typically grants, starting with grants first. You can get a grant depending on the city, depending on the program. There are grants out there that will allow you to offset your closing costs as well as or your down payment for your purchase. Now, the thing is about that is it depends on how long you're going to be in the home for. So if you're going to be in the home for, and some of these grants will say minimum of 10 years. And then once you've been in the home for a minimum of 10 years, then that second turns it starts as a second loan, then it converts into a grant where you don't have to repay it back. And so going into that silent second, so depending on where your rate is, it could be 1.5 to 2% higher than your first position mortgage. And so it is a some case a silent second, but then converted to a grant, or it could be a traditional second where it's about if the par rate right now is 6.5, then you might be looking at anywhere from 7.5 to 8%. Now, you're not talking about a large sum of money. You're talking, maybe 3%, 3.5%. Sometimes they can go up to 5%. Now, that's going to be if you're using an FHA loan, that'll be your 3.5% down plus 1.5% towards closing costs. That's where you get that 5% second. And so you do have those options. Now, there are some certain limitations. Part of those certain limitations is the idea around income, and so there is going to be a limit on income that you can gain from you can have towards these programs. So a lot of them are 110, 120,000, 150,000 in some cases, as far as income that you could make before not being able to qualify. Now, if you go over those numbers, obviously then you don't qualify for the program. So those are some things that you also want to consider and think about as well that give you some ideas. So I'm going to actually share my screen and give you an example of a program that is pretty popular in the state of California. We call it CalHFA. CalHFA, they're one of the more consistent and long going programs. And so, if I can zoom in here for you, here's basically the criteria for CalHFA. So you're looking at first-time home buyer, hasn't owned in a home in the last 3 years. Now, I know that's kind of, a little confusing. Okay, I've never owned a home before, but as long as I haven't owned a home in the last 3 years, so it's both. You can never have owned a home, and you can also haven't owned a home in the last 3 years and get access to this program. Primary residence only, you got to live in it. It's owner occupied, and when you're funding the loan and closing on the loan, the intention is that you're going to go and move into that property for a minimum of 2 years. Actually, you could do up to 1 year, but sometimes we got to make sure that we get compensating factors to be able to offset that if you are going to, whether it be decide to sell or keep that loan and refinance later. So a minimum 1 year is what you need if we can get your circumstance cleared with the underwriters. And then you guys, in a lot of cases, you got to take the home education course, making sure that you know everything that entails. 660. Now, that is the minimum score. I recommend 680 because now, if you have a 660, let's still talk. If you have a 640, let's talk. If you have a 620, let's talk. Because there's ways to get you to a 680. It may not always be like the next month. It may not always be in the next 3 months. It might be 6 months. However, it is definitely possible to get you to a 680. Now, 680 is a sweet spot where you can start to get a bit better pricing, and so that those numbers don't work against you and they work for you. All right.
Now, for those who don't know, when you say better pricing, what would that mean?
Interest rate, right? Better interest rate pricing on your loan for the 30 years. Great question. Thank you for bringing that up. And then debt to income ratio, 45 to 50% debt to income ratio. So it's basically the amount of your revolving debt compared to your monthly income. And so your revolving debt is basically everything on your credit report, your credit cards, auto loans, if you have any personal loans, furniture loans, student loans, all of those things, whatever's on your credit report that has a monthly installment, we're going to add all that up. And then and by the way, we're also going to add your housing expense, principal and interest, taxes, insurance to it. And we're going to look at the numbers and say, okay, including with your housing expense and your revolving debt, you can't be any higher than 50%. So round numbers, let's say you make $10,000 worth of income every single month, call it W-2 gross. You can't have your housing expense along with your revolving debt any higher than $5,000 a month. So 5,000, that's the max. Sweet spot is about 4,500 to 45% debt to income ratio on $10,000 worth of income. So the big thing there is that you definitely want to make sure that you're in those boundaries, right? And then now, if you don't know how to calculate that, reach out to me. Happy to run that with you and look at what your situation is now and compared to where you want to purchase or where you want to be in your financing. We can look at that for you as well. We do conventional and FHA for these programs. Obviously, income limits vary by county, and then again, this is all here. Let me confirm: non-occupying co-borrowers, meaning you can have a rich uncle co-sign for you, but they're not going to live in the property. You can't have that. You can have co-borrowers, but they have to be living in the property. So. Mercedes, anything that you'd add to that or things to think about as looking at now? This is just one example. We've got others. We've got a bunch of others, but this is something that I just want to, here's the general framework. Others are pretty similar. Others are close. Numbers may vary a little bit per county and all that, but this is just overall, here's what you're looking at for a down payment assistance program. Mercedes?
Yeah, I think, it's important to partner with people who are knowledgeable about not only just strictly CalHFA, however, there's Chinoa, there's a lot of different down payment assistance programs. So, whether you're choosing to work with us, whomever you hire, make sure that they're well versed in loan programs and grants for your areas. And I also say you too do your due diligence as well and research to see if your particular city or county is offering any grants that you can partner with the lender with your financing program to see if sometimes I've seen where you could do both, where you're able to get a city grant. I know Long Beach had a program for a while, Long Beach, California. And, this person was also using NACA, which is a zero down, also down payment assistance program a little bit more strict on their guidelines, and yet that's another opportunity for some people as well. So doing your own due diligence and making sure that you partner with someone who's just as knowledgeable as well is important.
Yeah, somebody like myself. All right, so as we're running through Mercedes, there's been some conversation about new loan updates, credit scores. So I think uh, Fannie Mac. So basically, our loan, some of the larger loan servicers and loan originations in the nation have put out that there's no more a uh, minimum to credit scores that you can use to finance. So they said it was it was 620, and they've removed that in general. Thoughts on that? How's that going to help folks? What's the story?
So that's a good question. And, when I read that, a part of me was shocked in a sense. And also, I could see the benefit to some people depending on their circumstances, right? So I think the important factor is to know is they're not being, they're not putting the red tape on it, right? However, it's still going to be up to the lender and the mortgage companies if they decide to move forward with you based on what your portfolio looks like. And I'll always advise, I mean, we've helped people who had no interest in getting their credit score higher. They just wanted to buy. I've seen people close on homes and, between 580 and 600. That was a choice that they made and they were okay with the rate and the payment that they had. However, as Brian mentioned earlier, if you are able to walk into purchasing a home with a better credit score, that allows you to also have a better rate, which then in turn also offsets your payment monthly too. So just keep that all in mind and be cognizant of, yes, the red tape is off. Yes, that does open more opportunity. However, just make sure that you're also comfortable with that rate that comes with that credit score, as well as, that payment. And if you do want to work towards raising your credit score, that's where Brian comes in and his team to be able to say, hey, here's the plan that we have. You need to do X, Y, Z, and this will get your credit score up to X. And that'll put you in a different bracket as far as rates. So I think that's important too.
Yeah, this is just the first shoe to drop when it comes to lending guidelines. Because just because Fannie Mae drops a minimum requirement doesn't mean that the other lenders or loan originators are going to go with that. There's something what we call a lender overlays, and those overlays are the guidelines that each mortgage company operates off of. So Fannie Mae says it's kind of like in the state of California, um, there's a minimum level of rent control. However, certain cities can level up the level of rent control and make it a bit more strenuous for the landlords when it comes to operating their properties. It's same thing with mortgages. So although that there's no minimum requirement for Fannie Mae, there is still a minimum requirement for a lot of these mortgage brokers. We have over 100 different lines and or connections with investors for our lender partners, right? And so we're a mortgage broker. We like to say we do the shopping for you. And a part of that is we've got lenders who can go down to 550. We've got lender partners that can go down to 580. We got folks who can go down to 500 with compensating factors. However, for the most part, it's been minimum 620 or above for financing for a large majority of them, because that's how they want to operate. They have a little bit higher threshold when it comes to being conservative. So with that being said, you don't be discouraged if you go to a lender and they say, well, we need a minimum of 640. All right, well, how come? I just heard Fannie Mae is there's no minimum. Well, we have our overlay that makes sure that we do a certain level of production at a certain range of credit score to make sure that our books are balanced or whatever the case is. And that's basically it's based all that to say it's lender discretion on how the financing terms are and or will be. Now, again, I use a term called compensating factors. So, for instance, if you have 550 credit score, but you've got the ability to do 10% down, they could probably run with you. Now, if that's not the case, right, and you have 3.5% down, or you're looking at 550, you're looking for down payment assistance, that's a no go. It's not going to happen. So, Mercedes, anything else you'd add on to that as we look at our other topics?
No, just be due diligent on who you partner with. Yeah.
Absolutely. Yeah, and, you mentioned something earlier about, the marry the home, date the rate. That's actually something that's very interesting. I think it's overused, and I think that it's something that can get some folks in trouble. Meaning, you got to know who you are. You got to know your situation. You got to know that your your because the whole premise is get into a home now. Obviously, you've been qualified. We know that you can afford it today, and you're comfortable in that payment today, based off of all the hoops you have to jump through. However, if you're hoping that you'll be able to refinance in a certain amount of time, just know that you've got to be on the right side of it, right? You got to be on the right side. Like, so fortunately today, right now, I just showed you a chart that mortgage rates are trending down. Now, what if somebody said, "Oh, I'm going to marry the house and date the rate in 2022, right? Beginning of," and maybe they're at a 4.5 or 5%, and then rates shot up to 7.5, and now you're whoops. Now,
Yeah, I mean, you got to be cognizant of what that looks like for you, right? I mean, if you're already below 5, I personally think you're winning.
You're good.
Yeah. So whether it's 3, 4, or 5, I think you're winning. That conversation is for those. I mean, there was a point where rates were in the 8s.
Mm-hmm.
And so that we don't foresee continuing on, as you see that we're down to 6.3 right now. Those who bought with 7%, 8%, even the high 6s, that's a conversation that you should be having, with your mortgage professional. Like, hey, what does it look like to refinance now? Or when do you foresee that I should be refinancing so that it does make sense for me? However, before you even go into that, I think that's the conversation that you need to be having, period, is, hey, if I do purchase at X amount, rate, what's the likelihood that I will be able to refinance in a year, 2 years, so that you know what you're walking into and being okay that it may take some time as well.
Yeah, you got to know where you're at, right? You got your confidence in your job situation, confidence in the market situation, and then overall just confidence in that you worst case scenario, you're comfortable where you're at with the current mortgage payment that you currently have, right? So obviously, you're not into an adjustable mortgage, and you're like rolling the dice, hoping that, all right, the rates are going to drop before. No, 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 no. Right. Let's make sure that you're in something that you're comfortable with. It's fixed, and that or even if you did a 2-1 buy down, or 3-2-1 buy down, that at one point your loan is going to be fixed, right? And so that's how folks got in trouble back in the original subprime crisis, where a lot of folks were in adjustable mortgages. And then so they got into adjustable mortgages, and then these rates were changing over every 1 year, 2 years. Sometimes they were changing every 6 months. And then if that's the case, you're hoping that, rates are kind of, you can refi later. But if your documentation isn't right, or your job situation has changed, or even rates have gone up, you might be stuck in that situation. So, the best way to do, if you're going to marry the house, date the rate, make sure you get something fixed. Make sure that that confidently, in worst case scenario, I can be in this mortgage for 5 years, 6 years, 7 years and be good. Would I love to be at a 1% or 2% less? Absolutely. And yet just, be cautiously optimistic that you'll have a better interest rate in the future. I wouldn't even say that. Maybe a little pessimistic, a little pessimistic, um, pessimistic, optimistic, like a balance. I'm making this up, but but you have a balance for how you're going to um, approach your finances or refinancing later. Meaning, all right, worst case scenario, I can be in this thing for another 10 years. We're good. Would I love to be at going from a 7% to a 5%? Absolutely. But is it going to break me today? Is it going to break me in the next few years? No, probably not. That's where you would love to be. So I wanted to just kind of clarify that. We talked about that before in the beginning, and yeah, I just wanted to make sure that we at least were clear about just best practices for going into a marry to home, date to date type situation. Uh, Mercedes. So anything on your mind when it comes to how home buyers can win? We've been kind of talking about home buyers recently, and so if we gave our wealth building strategy of the show, if you will, what would that wealth building strategy of the show today is going to be for first time home buyers? How would you advise a first time home buyer to win in this market in the next 90 days? Right. So there's something strategic about buying in the winter, right? We kind of just all highlighted that there's going to be some motivated folks out there who just need to sell by the end of the year or want to get something, get that chapter closed and move on to the next situation. And so if you're a buyer today and you've got the job, you've got the income, right? So you've got the income, you've got the down payment, or you have the ability to get the down payment, whether it be a gift or down payment assistance or whatever, 401k. Um, and then you also have the credit, and you've been thinking, I can buy a home right now. However, I just don't know about timing. What would you tell that person? And if they were saying, okay, timing actually seems good, how can you help that person win in the next 90 days and becoming a homeowner?
I think it's important to build your team, right? Secure a wonderful, educated realtor like ourselves, as well as mortgage partners that know what they're doing. And I say that to say because then we're able to educate and get you in the right position to win. So even last night, I had two buyer consults late last night, and two different scenarios. One's moving from out of state, another's local, however, self-employed. And both have dreams of home ownership here in California. And the conversation I had with both of them is, if it's in you to want to do this, start now. Don't wait 6 months from now and be like, hey, I was scrolling on Zillow and I found this house. I love it. I want to buy it. Well, without knowing what everything looks like as far as your credit and your income and your assets, it might be another 6 months before you're able to buy. So get in those conversations with the right team to make sure that you're on the right track to be able to do so. What that means is, once you have your initial consult with myself, and next we're setting you up to have a consult with our mortgage professionals to see what your credit, income, and assets look like, if you need to work on anything, or if you're in the position now. And so I had a conversation last night, is this the start to the forever home for you? Meaning right now you're ready, willing, and able. You may be able to buy. Is it at the price point that you thought? Maybe not. Is it or is it? And then you're excited. If it's not, are we spending another 6 months to maybe save more money or get your credit score up? Or is it, what, Mercedes, I just want to get something now. I'm okay with getting the start to my forever home just to get my foot in the door for home ownership. And that's what we mean by getting your strategies in order and being able to be able to purchase within 90 days, is getting everything that you need in order. So it's a conversation with the lender. If you haven't filed taxes, make sure you're getting that done. Make sure you're getting all the documents and things in order so that when that dream house does hit the market, you're ready and you're able to use our framework that gets you into that house through, our negotiations and everything like that.
Yeah, I mean you're 100% right. So to me, it sounds like a lot of preparation.
The prep is the formula. Getting everything going, even just at the end of my consult, before even speaking to the lender professional, it's like, hey, before you file your taxes, have a conversation with the lender to make sure that you're filing them properly. That'll put you in a position to have home ownership, especially if you're self-employed, as well as start getting your hands on things, your W-2s, make sure your bank statements, make sure if you are someone who does not believe in banks, the mattress money we talked about before, start having those conversations. Hey, I have savings. I want to utilize this towards buying a home. I haven't put it in a bank. What does that look like? It's all prepping you to be able to buy that home. And it usually, from start to finish, I would say a good 90 days, especially if you're following the plan and you're coachable in the sense to be able to make sure that you're in a winning position.
Yeah, absolutely.
We say winning and stuff a lot of basketball heads over here.
Well, yeah, winning is relative. So winning might be, you being able to buy your first home, get that first property, whatever the case is. So winning is relative. Yet, everybody should win.
Everyone should win.
Everybody should win. And that's part of the movement, right? That's part of why we do what we do. RESWealthy team is in the business of education. It's in a business of empowering and helping people make the best decision possible. So, with that's why we created the RESWealthy.com. And so you can go to RESWealthy.com right now and see what we're about, gain access. Not RESWealthy team. RESWealthy team, you go there if you want to search some homes. However, just RESWealthy.com will take you to our site where you can get access to all of our workflows, right? So basically learning how to buy a home, how to invest, how to mortgage finance. I mean, we've got courses and curriculum already there set up to help you make good decisions. Again, it's completely free. It's no cost. For us, the whole point of it is just to help people make good decisions. No matter where you're at in the country, it's going to help. And it is going to help you just at least get on the first start of it all, right? And so if you're like, all right, let me see what I need to do before I have a conversation with a professional. By the way, it's never too early to talk to a professional. However, if you're like, hey, I want to do a little bit more research, I want to be a little bit more well-read going in, RESWealthy.com is a great resource for you to do that because it's going to help you. Basically, we created it as everything that we wish we would have known before we would have started, before we started purchasing property. And so when you start buying a home, then if you don't have the right team, like you mentioned, you start having to go over here and over there. And okay, let me search on YouTube if I can find it. Let me search on Google. Let me chat GPT it today. But you got to put all this information together for yourself. Whereas, we created that as a hub for a one-stop shop specific for, what's going on right now and how you can be helped and answering the questions that a lot of folks may not be able to get answers to. We have a course that we call DTI Secrets Unlocked. Right, debt to income ratio secrets unlocked, because that's probably we created that one because that's probably one of the biggest frustrations for people when financing is like, hey, I make all this money, why can't you give me more of a loan? Mm-hmm. And then they don't understand that there's the criteria and ratios that the banks go off of to mitigate the likelihood of foreclosure. And they want 45% max DTI. FHA could go up to 51, 52, 53%. However, those are all things that, that isn't often discussed or talked about. So we walk you through it. We walk you through it slide by slide. And so those are just some examples of what we're doing to give you education up front. So that way you can make a better decision later. So Mercedes, anything that I missed as we're heading out? What are you leaving our folks with? How are we wrapping this conversation up? And what should they be doing?
Talking to us. No, I'm kidding. But no, I'm not kidding. No, seriously. As Brian mentioned, it's never too early to start the conversation. There are people that, have picked up the phone, shot me a text, and we didn't do anything together for 2-3 years. They just wanted to start having that conversation, know what that looks like, and get things in order for themselves. Sometimes, people are getting just out of school or starting a new career field. So they need to work in that career field for a little bit to be able to buy a home. However, had they not picked up that phone 1 year prior, 2 years prior to know, hey, this is an overlay that the lender may ask for you. So here's what you need to work on so that when that 1 year mark hits, that 2 year mark hits, you're ready to buy. So the conversation is now. If you feel it in your spirit, if something's telling you, I want to buy, start the conversation now so that when you are ready, there's no waiting game. You've done the legwork to get to that point where you can buy.
Yeah, well said. Well said. Do the research. Get prepared. It's never too early. And one of the last things like we'd want for you, and this happened with us early, we're in the business where we know we attempted to underwrite our own file. And when you do that, there's going to be things that you're going to miss. And then you're going to spend all this time thinking that you've got it. And then once you talk to somebody like myself, or we start getting your paperwork processed, and then we find out, oh, well, we have to figure out this with your tax returns, or oh, hey, you make income with your 1099, but you also have a W-2, but you don't have enough history. So then we start looking at all of that, and then because of that, we don't, we need more time. And so you may have said, hey, here's my goal. I want to be in a home by, end of December. But then you're like, okay, I'm ready to go. And then, you touch base with a lender like myself. And then you come to find out, you're like, well, we need another year, or we need this amount of money, or we need, and then all of a sudden your timeline gets pushed back another year, 6 months. So the sooner you can have the conversation, the better, because that will allow you to be basically get the answers to the test before you take the test. When that happens, now you can get prepared, and then their likelihood of you passing is way higher. So, with that being said, share, like, subscribe. RESWealthy Talk. I trust it's been a valuable conversation for you, more insight into the game of real estate and finance, and really making sure that there's no gatekeepers here. Our goal is to move everybody forward and keep that information revolving, circulating, and making sure that it's in the hands of the folks who most will appreciate it and who are going to do something with it. Meaning, let's go ahead and narrow that home ownership gap and make more folks like you and me own property and help them set up their generations accordingly. So, with that being said, again, thank you for tuning in for another episode of RESWealthy Talk. And with that, don't forget, like, share, subscribe. Mercedes?
It's been wonderful. Thank you all for joining.
Go.